It's time for another Friday update on the Canadian housing market. And today I'm wearing warm clothing to indicate that it's December. Today I've got 3 stories for you, and they're all pretty much bad. If you're not ready for that, I would suggest going and watching some videos of this parrot. His name's Apollo, and he knows what things are and what things are made of. First up, GDP numbers for the third quarter of 2023 came in, and we saw a decline of 1.1%, which is significantly worse than the 0.2% gain predicted by analysts, and much worse than the 0.8% gain predicted by the Bank of Canada. However, we narrowly avoided falling into a recession, which is defined as 2 consecutive quarters of negative GDP growth. This happened because the GDP numbers from Q2 were revised from a 0.2% drop to a 1.4% gain. Phew, close one. Now, is real GDP per capita continuing its steady decline that started over a year ago? Sure. Has our real disposable income per capita now fallen below pre-2020 levels? Yes. But don't worry, even though you and everyone else in the Canadian labor force may be experiencing the practical effects of a recession and have been for over a year now, we're not technically in a recession, and that's what's important. Next, Stats Canada has released a report that reveals the biggest factor in young people being able to afford a home: having parents who own a home. It turns out the most important thing in determining whether or not you'll be able to afford a home or not is whether or not you come from a family that already owns real estate. One interesting finding was that even people born in 1990 only have a 33% homeownership rate, which is half the national average of 67%. These are people in their 30s, and fully 2/3 of them haven't been able to get into homeownership. Of course, there's a lot of variation within that group, with people whose parents own 3 or more properties being almost 3 times as likely to own property compared to people whose parents own none. This ratio is also more pronounced among people who have lower incomes, with the gap closing somewhat for people who earn over $80,000 a year. Now, obviously this is more or less a consequence of generational wealth in general, but in Canada, the amount of paper wealth people have gained through real estate in the last generation seems to be dividing us into 2 classes: land-owning families and renter families, with less and less opportunity to move from one to the other. Finally, RE/MAX is predicting a price drop in the GTA for 2024. I know that doesn't sound that big on its own, but this is a major realty association we're talking about here with a vested interest in positive market sentiment. I don't think I've ever seen them predict that prices were going to drop before. In the report, they project a rebound in sales, but a second consecutive year of declining prices. The fact that even a real estate association is saying this should lend a bit of credit to the idea that high demand for housing is not enough to sustain prices on its own. As I mentioned last week, TD is projecting a 10% decline in prices by the early part of next year, so we'll see how things play out in the coming months. A weakening economy will likely lead to some rate cuts, but we still probably haven't priced the rate hikes into housing yet, and less disposable income will decrease people's ability to pay high prices. It should be a super fun time! That's all for this week, so as always, thanks for watching and enjoy your weekend.